Of all the principles that constitute the science of speculation, none is more vital and none more universally neglected by the public than the art of managing losses. The average man comes to the market with his mind fixed solely upon the profits he hopes to make. He dreams of the 10, 20, or 50-point gains that will secure his fortune. His focus is entirely on the reward. The professional operator, by stark contrast, begins his every calculation from the opposite end of the equation. His first and most pressing thought is not how much he can make, but how much he can afford to lose. Richard Wyckoff observed this fundamental difference throughout his long career on Wall Street. He saw that the public's failure was not primarily a failure of stock selection, but a failure of capital management. They did not treat trading as a business. This video is a deep dive into the foundational rules that Wyckoff established for managing capital and, most importantly, for preserving it. It is a guide to the single most critical tool in the trader's arsenal, the stop-loss order. We will explore not just the mechanics of where to place a stop, but the profound business philosophy that makes its use non-negotiable for anyone seeking long-term success in the market. Before we continue, please subscribe and leave a quick comment, even one word. This small action helps the algorithm show this video to more people and tells me these deep dives are worth making. The cornerstone of Richard Wyckoff's entire approach to capital management is a single powerful idea. Rule number 1, make trading a business or do not engage in it at all. He saw that the vast majority of people who lost money in the market were not defeated by the cunning of manipulators or by some inherent difficulty in forecasting prices. They were defeated by their own amateurish approach. A successful merchant would never start a business without a detailed plan, a thorough understanding of his goods, and a strict accounting of his expenses and potential losses. Yet this same merchant would come to Wall Street and risk thousands of dollars on a whim, a rumor, or a hopeful guess. To treat trading as a business, in Wyckoff's view, meant embracing a set of disciplines that were entirely foreign to the average speculator. It meant, first and foremost, a period of serious preparation and study. He himself, as we have discussed, spent 8 years studying the market before making his first investment, and another 6 before he began active trading. He understood that knowledge of market technique was far more valuable than capital in the beginning. Without knowledge, capital is merely fuel for the market's fire. It also meant developing a clear and logical method of operation. A businessman has a process for buying inventory, pricing his goods, and selling them. A trader must have a similar process for identifying opportunities, entering positions, and, most critically, exiting them. This method, based on the analysis of supply and demand, is what separates the professional from the gambler. Furthermore, treating trading as a business meant keeping meticulous records of every transaction. The professional trader must be a scrupulous bookkeeper. He records his trades, his reasons for entering them, and the results. He then studies his losses with even greater intensity than his profits. A loss, when properly analyzed, is not a failure. It is a lesson. It is tuition paid to the market for a piece of valuable education. The trader who does not learn from his mistakes is doomed to repeat them until his capital is exhausted. This constant process of self-examination and refinement is the hallmark of a true professional. From this central idea of trading as a business, all other rules of capital management naturally flow. The first and most destructive habit that a business-like approach must eliminate is the one Wyckoff saw as the primary cause of financial suicide on Wall Street. This is rule number 2. Never overtrade. Overtrading is a ruinous practice that manifests in 2 ways. Trading in quantities that are too large relative to one's available capital, and trading too frequently with no sound reason for each commitment. The man who overtrades is acting not from a position of calculated analysis, but from a position of greed and impatience. Wyckoff observed that the average man with $10,000 in capital wants to begin by trading in 500 or 1,000 share lots. He wishes to start at the top, and inevitably, he works his way down. It is only a question of time before he is forced to trade in 100 share lots, and then in 10 share lots, as his capital is eaten away by losses that are too large for his account to sustain. The professional, Wyckoff noted, does the opposite. He begins with small commitments, testing his judgment and the market's temper. He increases his trading size only as his capital is built up out of profits. To overtrade is to place oneself in a state of constant financial and emotional vulnerability. A single unexpected move can cause a crippling loss, wiping out the gains of many successful trades and severely impairing one's ability to continue. It destroys mental poise. Fear becomes the dominant emotion. A trader who is risking too much on a single trade cannot think clearly. He will be swayed by every minor fluctuation. He will close out a profitable trade too soon out of fear of giving back a small gain, and he will hold on to a losing trade for too long out of a desperate hope that it will come back. Overtrading is the enemy of clear judgment, and clear judgment is the professional trader's most valuable asset. The correct approach, Wyckoff taught, is to trade in amounts that are small enough to ensure that the outcome of any single trade is of no great consequence. This allows the trader to remain calm, objective, and focused on the correct application of his method rather than on the money involved. With the foundational principles of a business-like approach and the avoidance of overtrading in place, we arrive at the most critical, practical tool for financial survival. This is rule number 3. Always limit your risk. For Wyckoff, this was not a suggestion. It was an ironclad law. The active and unwavering limitation of risk, he believed, was the single greatest factor that separated the successful professional from the chronic loser. The mechanism for achieving this is the stop-loss order. The philosophy behind the stop-loss is simple but profound. It is the explicit recognition that you can and will be wrong. No matter how thorough your analysis or how strong your conviction, the market can always prove you wrong. The stop-loss is your predetermined plan for what you will do in that event. It is an insurance policy against a catastrophic loss. Wyckoff used the analogy of insuring a house against fire. A prudent man does not fail to insure his house because he does not expect it to burn down. He pays a small, known premium to protect himself from the devastating and unknown cost of a potential disaster. The risk on a trade, the distance to your stop-loss, is that small, known premium. To trade without a stop is to leave your entire financial house uninsured, vulnerable to the first unexpected fire. The public consistently reverses this logic. They take a small profit out of fear, but they hold a large loss with hope. The professional does the exact opposite. He must fear that his small loss may develop into a much bigger loss, and he must hope that his small profit may become a big profit. The stop-loss is the tool that institutionalizes this professional mindset. It is a mechanical and unemotional execution of a business decision made when the mind was clear and objective before the trade was even entered. E. H. Harriman, the great railroad magnate whom Wyckoff studied, began his career as a floor trader and was known for his mastery of risk. He once said, "If you would be a successful trader in stocks, kill your losses." The stop-loss is the instrument with which this is done. One of the greatest obstacles for the novice trader is overcoming the psychological pain of having a stop-loss order triggered. It feels like a failure, a small but stinging defeat. Wyckoff taught that this perspective is entirely wrong. The successful execution of a stop-loss is not a failure. It is the successful execution of your risk management plan. It is a victory for your discipline. When a stop is hit, it simply means that your initial judgment about the stock's immediate direction was incorrect. The stop-loss has done its job perfectly. It has cut the loss short, preserved the vast majority of your capital, and allowed you to step aside with a clear mind, ready to analyze the market anew and wait for the next, better opportunity. The trader who moves his stop-loss order to accommodate a growing loss, hoping that the market will turn, has abandoned the realm of business and entered the realm of pure destructive gambling. He has replaced a logical plan with a desperate hope. And in the stock market, hope is a certain path to ruin. This leads directly to the final foundational rule of capital management, a principle that ties the concept of risk directly to the potential for reward. This is rule number 4. The anticipated profit must be at least 3 times the risk. This rule is not about predicting the future with certainty. It is about playing the probabilities in a way that ensures long-term profitability. It is a simple yet powerful business principle. Wyckoff understood that trading is a game of averages. No trader can be right every time. Losses are an inevitable and recurring part of the business. Therefore, for the business to be profitable, the average profit on the winning trades must be significantly larger than the average loss on the losing trades. The 3-to-1 reward-to-risk ratio is the minimum standard that makes this possible. Before entering any trade, the Wyckoff analyst must perform 2 calculations. First, he must determine his risk. This is done by identifying the logical point for his initial stop loss, a topic we will cover in great detail. The distance from his entry price to his stop-loss price is his defined risk on the trade. Second, he must determine his potential reward. This is done by using a logical method of analysis, such as the point and figure counting technique, to project a reasonable price objective for the move. If the potential reward is not at least 3 times the initial risk, the trade is simply not taken. This discipline has a profound effect on a trader's results. It forces him to be patient. It compels him to wait for the very best opportunities, the A-plus setups, where a stock is poised for a significant move from a point where a very close stop can be used. It eliminates the temptation to trade on low probability, marginal setups where the potential profit is small and the risk is ill-defined. By adhering to this rule, a trader can be right on only half of his trades and still be handsomely profitable. Imagine 10 trades are taken. 5 are losing trades, and each one hits its 1-point stop loss, for a total loss of 5 points. The other 5 are winning trades. Because of the 3-to-1 rule, their average profit will be at least 3 points, for a total gain of 15 points. The net result is a profit of 10 points. This is the simple, powerful mathematics of professional speculation. It is the application of sound business principles to an endeavor that most people treat as a game of chance. It is the foundation of financial survival and ultimately of consistent success. Having established the fundamental philosophy behind the stop-loss order, that it is the ultimate tool for capital preservation and the bedrock of a professional, business-like approach to the market, we now transition from the why to the where. Understanding that a stop is crucial is the first step. Mastering the art and science of its correct placement is the second, and it is a skill that separates the novice from the expert. A properly placed stop is not a random guess or a measure of one's personal pain tolerance. It is a strategic decision based on the market's own testimony. It is placed at a logical point on the chart that has a direct and meaningful relationship to the reason the trade was initiated in the first place. The first principle in learning how to place stops correctly is to completely reject the arbitrary stop. The average speculator, if he uses a stop at all, tends to place it based on an arbitrary figure. He might decide to risk 2 points or 5% on every trade, regardless of the stock's character or the market's current structure. Wyckoff taught that this approach is fundamentally flawed. The market has no knowledge of and no concern for a trader's personal account size or his predetermined risk percentage. A 2-point stop may be far too wide for a quiet, low-priced stock, leading to unnecessary losses, while being far too tight for a volatile, high-priced leader, causing the trader to be shaken out by normal fluctuations. The core principle of Wyckoff's placement strategy is this: the stop-loss must be placed at the one point on the chart that conclusively invalidates the original reason for entering the trade. This is a profound shift in thinking. A trade is not proven wrong simply because a certain amount of money has been lost. A trade is proven wrong because the market's subsequent behavior has demonstrated that the initial thesis, the logical case for the trade, is no longer valid. The stop loss, therefore, is not just a financial backstop, it is a technical one. It is placed at the danger point, the price level that, if violated, signals that the underlying technical conditions have changed, and that the trader's initial analysis was incorrect. The art of placing the stop, then, is the art of identifying that precise danger point for every trade. Let us now delve into the specific technical method for placing these logical stops. We will first examine the rules for placing stops on long positions, which are trades initiated with the expectation of a price advance. In every case, the stop is placed just below a valid point of technical support. The definition of valid support changes depending on the context of the trade. We will begin with the most opportune moment to buy, at the end of a period of accumulation. One of the most powerful buying opportunities, as we have discussed, occurs after a spring or a shakeout. This is the final manipulative drive below the support of a trading range. When a trader buys in confirmation of a spring, that is, after the price has recovered and moved back into the trading range, the stop-loss order is placed at the most logical point possible, just below the extreme low of the spring itself. The reasoning is perfectly clear. The thesis for the trade is that the move below support was a false move, a bear trap, and that the composite man has now taken control. If this thesis is correct, the price should not return to that extreme low. A subsequent decline that violates the law of the spring would invalidate the entire thesis. It would indicate that the initial move was not a spring but was, in fact, genuine weakness, and the trader must immediately exit the position. Another excellent entry point is after a secondary test in the latter part of an accumulation range. A successful secondary test